A very good evening, everybody. Welcome to the live webinar on Options for Beginners, a two-part fundamental guide. I'm Ming Hui from Phillip Nova, and tonight's webinar is held in collaboration with CME. Breaking down what derivatives and options are for us tonight will be Sri, founder of Min Finance, and Pranay, head of research of Min Finance. Before I pass the time to the speakers, please be reminded that if you have any questions throughout the course of the webinar, you can drop them into the questions box and we will address them during the live Q&A session towards the end. And now, without further ado, I will pass the mic to Sri.
Thanks, Ming Hui. Good evening, everyone. Welcome. Thanks for taking the time this evening. Ming Hui, I'll share the deck on my side. Ming Hui, if you can confirm that you're able to see the slides.
Yes, we are good to go.
Okay, excellent. Cool. Once again, welcome. Good evening, everyone. Thanks for your interest today for this webinar. So this will be a two-part webinar. So starting first with the agenda. So what we will cover today is part one. This will be delivered in 5 parts. Introduction to derivatives. We'll also take an overview of equity index options, so that whose volume has grown massively over the last few years. We'll also look at the benefits of using options and its common use cases. We'll also look at risks in trading options. As you all can appreciate, every form of trading is beset with risks, but trading options uniquely creates additional risks, and that's what we will talk about. And in section 5, we'll look at the construction of options payoff charts. Today's session, deliberately and intentionally, is going to be very fundamental, and we wouldn't be getting into specific illustrations of trading strategies or associated methods or techniques. So we will focus on the foundational elements today, and when we come back again in 2 weeks' time in part 2, that's when we will unpack options in greater detail. We'll look at different types of options, different styles of expiries, moneyness of an option, and option Greeks as well. We'll look at what does it take to price an option. What are the tools available for investors like yourselves who can price any option and see what that looks like in relation to whether it is cheap or expensive. We'll cover all of that. Then we'll also cover volatility. As many of you may appreciate, trading options essentially translates into trading volatility. We'll do an introduction to that as well. Then section 4 of the second webinar is where we'll look at basic options trading strategies. We'll look at the fundamental ways in which participants can get started with options in a risk mitigated way. So that's what we will cover in part 2. And we'll also touch upon risk management considerations. Options traded astutely can be very profitable. Profits not guaranteed, can be profitable, but risks can be vastly minimized. So without further ado, we'll get started with a brief introduction to Min Finance. So we as a company, we have 3 business practices: consulting, research, and education. In research, we write on 3 broad themes. We write about artificial intelligence, we write about energy transition, we write about changing world order. As you can imagine, the world is going through a flux, and that has big implications on asset values, on stock prices, on commodity prices. So we write about all of these. On a given week, we publish more than half a dozen research notes. We have 3 consulting practices. We advise our institutional and corporate clients on risk management. We have a capital markets practice. We also advise high net worth individuals on portfolio construction. In terms of education, we conduct workshops, much like this one. We also conduct half-yearly event called Navigating Global Macro, wherein we look at what's happening at the world at large and how that impacts investor portfolios. And we're in the process of starting Demystifying Markets, where we take up different topics and kind of unpack what's happening in that particular space. So quick disclaimer. So this material that is being presented today to you is for general education purposes only. It does not offer any specific investment or risk management advice. So we will be presenting results, and past results, as you can appreciate, is not indicative of future performance. All examples used in this webinar are hypothetical and used for explanation purposes only. And what happens in the actual market could be very different from what these examples may point to. So keep that in mind, because ultimately, this is a big boys game, as you can appreciate. So playing this astutely, one can, meaningfully progress their advance their portfolios, but it has its pitfalls, and that's what we're going to talk about. What are the best ways in which one can navigate around these pitfalls? So that'll be the key objective of this webinar today. Before I actually begin, I want to ask you 6 questions. So please bear with me, right? First, under which of these conditions can you invest profitably? In rising markets, can you invest profitably? Answer is a yes. You buy low, sell high, given, right? Can you invest profitably in falling markets? The answer is a yes again. The beauty of derivatives is that it's a tool that is so finely constructed that it doesn't matter if the markets are rising or falling, you can make money either way. It is possible. So are the risks as well, but it is possible to make money. The next question I have for you is, you don't know the price in which the asset will move. So take any example, right? Results, quarterly earnings are coming up. Apple share prices. Will it go up or come down? Who knows? But we know that it might have a sharp move when the results are out. Can we make money in that setting? And the answer is a yes, you can. Let's take another scenario. When markets remain flat, they don't move. Is it possible to make money? Once again, the answer is a yes, it is possible. Then, when one asset outperforms another, is it possible to make money? The answer is a yes again. And you know what my answer will be now, right? When one asset underperforms another, the answer is a yes again. So the beauty of having derivatives within your toolkit is that it makes you a lot more nimble to be able to participate in markets regardless of which way it moves, or regardless of the way, even if it doesn't move, you can advance your portfolio, build onto your portfolio. But the question is, you must have insight as to what it will do. And if you get your insight right, then you could be in the right place to build your portfolio further. So with that, let's get started, right? Introduction to derivatives. So bear with me, because I was told that some of you are familiar with derivatives, some of you may not be. So what we want to do is take a step back, understand what derivatives are before we start getting into index options in particular, right? So starting first with introduction to trading. So there is one principle in trading. So trading is simple, but not easy. There are 2 rules of trading. Bear with me, this is a bit of a tongue in cheek. So buy low and then you sell high. You sell high and then you buy low. Then there are 3 types of trading, and that I've already alluded to when I asked those 6 questions. So those are directional trading, which is, you have a view of where the prices are going, so you accordingly establish your portfolio. Or there is a relative value, where one asset price moves faster relative to the other asset price, or the speed with which the market moves. So this again was an example that I mentioned earlier, right? Wherein a price of a stock could move sharply, but we don't know which way. But if you know which way, that it is going to be fast, you can construct a trade that gains from that. Or by the same token, if an asset price may not move necessarily fast, you can gain from that as well. In terms of introduction to derivatives, right? So if you think of the broad derivatives universe, if you take a 30,000 feet view of the derivatives market, you have broadly 2 classes of derivatives. There is OTC, over-the-counter derivatives, and there are listed derivatives. So the different instruments in these, broadly again speaking, fall into 3 categories. Forwards and swaps goes under OTC derivatives, and futures goes under listed derivatives. Then you have options. Typically, when people refer to options, so they are OTC derivative options. When we talk of listed options, so those are on the listed markets. Then structured products. Banks typically, think of all the big banks, right? JP Morgan, Goldman Sachs, Morgan Stanley. They can construct a whole range of structured products catering to different kind of investment objectives. Unless you're a very large participant, either an ultra high net worth individual or a large institution like a hedge fund or a family office, typically you wouldn't be able to participate in structured products. But using options, you can construct, do-it-yourself instruments that can replicate the performance of structured products. I believe there is a bit of background noise on my end. Pardon me, if you could give me a second, I'll kind of fix that. Sorry. Sorry about that. I hope it should be better now. Sorry, thanks for bearing with me. So again, just a quick recap, a 30,000 feet view of derivatives. So the OTC derivatives and the listed derivatives. So when we talk of CME products, when we talk of products that you can access through Phillip Nova, so those would be listed derivatives. So the ability to access futures, listed options, and constructing using futures option stocks. You can do it yourself in building a portfolio. So very quickly, we move to unpacking futures. So futures and options are specialized and standardized contracts entered between two parties for trading and or risk management. Think of any contract, right? It could be a rental agreement, it could be a contract to buy a vehicle or a loan. So these are no different. These are simple contracts, just that they're standardized and they're specialized. Futures are contracts that are traded on an exchange and are cleared by a clearing house with customers having an account with a clearing member. So let's kind of assemble all of this here, right? So if you were to trade a micro S&P index futures, so these are traded on CME as an exchange. CME is an integrated exchange and a clearing house, and they're cleared on CME clearing. And to access CME, you need to have an account with a clearing member to CME, which in this case would be Phillip Nova. So you understand the different parties and who you need to work with as participants on the exchange. So futures contracts involves a promise between two parties that at some pre-agreed future date, which is a futures expiry, one of them will buy and the other will sell a pre-agreed fixed quantity, which is a lot size, of an asset at a pre-agreed price. Think of S&P 500, right? So today S&P 500, I'm just picking up a random example, random number. Let's say the index is at 5,800. So you could be trading a contract that expires in 3 months and you believe that the prices will go up. So what do? You buy today. So you have bought something at 5,800. If the prices do rise, you stand to gain because on, let's say 3 months from now, S&P is 6,200. You are able to buy something at 5,800 when the current price is at 6,200. So you have 400 index points in your favor. So that's what a futures contract helps. So if you think of futures much like buying a stock, right? Again, I'll come back to why I'm stating this statement, right? Both parties in a future contract are obligated to one another to always perform. And we will distinguish that in the context of options. To ensure parties of the trade keep up to their promise, both the buyer and the seller are required to post margins with the clearing house. So again, Pranay covers the payoff charts later on in section 5. We will go in greater detail, right? So the payoff chart for a futures contract looks like the one on the top, wherein as the underlying futures, index moves higher, the long futures or ability to have bought a futures contract increases in value and you profit as a holder. If the price index falls, then you start booking a loss on your trade book. By the same token, in fact, in inverse, if you're sold futures, so the beauty of derivatives again, right? You don't need to hold the asset to sell them first. You can sell first and buy back later. If you've sold futures, when the index drops, you profit, and when the index rises, then you lose because you're positioned to gain from a falling market. So that's what a sell futures position would do for you. So let's look at options now. Having heard about futures, let's look at options, right? So options like futures also involves two parties. But in this case, one party acquires a right to buy, acquires a right. If it's a right to buy, it's a call. If it's a right to sell, it's a put. A pre-agreed fixed quantity of an asset at a pre-agreed price, which is the strike or the excise price, at or before a pre-agreed future date, which is the expiry date. Let me rephrase that, right? So just so that we're all on the same page here, because typically in a textbook, this would be covered in 10 pages. We're trying to, force fit that into a single slide. So options involve two parties. Just that in the case of futures, both parties have an obligation. In the case of an option, one party has a right, the other has an obligation. The party who has the right is referred to as option buyer or option holder. The party that takes on the obligation is the option seller. If it's a right to buy, it's a call. If it's a right to sell, it's a put. That's simple, right? What are we trying to buy or sell? A pre-agreed fixed quantity of an asset at a pre-agreed price at or before a pre-agreed future date. So that's the expiry date. And we will talk about different expiry styles. American options you can exercise anytime from now until expiry. With a European option, it's only at expiry. We'll come into those nuances in part 2 of this webinar. Again, as you all may appreciate, right, in finance or in life in general, there are no free lunches. Likewise in the options market. In consideration for granting the right, the option seller collects a premium from the option buyer. And what is this premium? The premium is essentially the option price. So he collects this price to grant the right to the option buyer to either buy from them if it's a put, or sell to be sold to them if it's a call. Right? So those are the two options. And because he's taking on that obligation upon himself, the option seller collects a premium from the option buyer. To ensure that the option seller keeps up to their promise to trade, such sellers are required to post margins with a clearinghouse. So this is important, right? Because as an option seller, you have the obligation and the losses can be magnified. And these sellers are on the hook for margin calls if there is not enough equity in their account. Once buyers pay premium upfront, they are not required to post any additional margins with the clearinghouse. So for the benefit of option holders, so all they need to do, their only cash outflow is the premium and the transaction cost, if any. Once that is done, it's no hassle from then on. What is the worst thing that can happen to an option buyer? They lose the premium. The upside is potentially, in theory at least, unlimited. The downside is capped. So that's the beauty of the option, and we'll come back to that in a short while. So here are the 4 option payoff charts, right? If you have bought a call, so you will essentially, the payoff looks like this. So if the prices of the underlying falls, what you lose, the maximum you lose is the premium. If the asset price shoots above point A, you start making money. I mean, think of this as GameStop, right? I don't know how many of you were into the meme stock frenzy a few years ago. GameStop rose from, if I remember my numbers right, from $30 a share to about $450 a share. So the profits on this call option would have been astronomical. Each share is 100 lots. Each lot is 100 shares. If you were to buy a put option, so if the price of the underlying falls below point A, this trade stands to make money. In theory, again, stock prices don't fall below $0. So you could potentially make from this point A onwards minus the premium. This is the maximum profit you can make on a put option. If the price of the stock moves against your position, which is if it starts to rise, unlike a short position on a index future or a stock, you don't lose a lot of money. Your loss is capped to the premium that is paid. Contrast this with selling a call or selling a put. Limited upside, unlimited downside. Limited upside, potentially significant downside. We will cover all of this in section 5 when we construct a payoff chart. So moving on, just so that we put all these things together in section 1 and before we move on to section 2, right? Futures and options, they are different. Specialized contracts, standardized contracts, but different. What is the payoff in a futures contract? It's unlimited gain, unlimited losses in theory. For options, the payoffs are asymmetrical. If you're long option, unlimited upside, limited downside. If you're short option, which means if you're sold an option, limited upside, unlimited downside. Risk elimination. Futures, the power of the futures contract is eliminates both upside and downside risk. The thing with risk is that risk is not necessarily a bad thing. Depends on which side of risk you are. If you're holding a stock and the risk results in the stock price shooting up, it's a great thing for you, right? You wouldn't be upset about if the stock prices went up 30% overnight. Look at what's happened to Tesla over the last the last 9 days. Tesla share prices have just kept on shooting up. If you're holding Tesla shares, you should be laughing to the bank. But if you're short Tesla shares, that's a different story. So it depends on which side of risk you are. But with futures, you eliminate both upside and downside. With options, if you're a buyer of an option, your downside risk is limited or eliminated, while the upside potential of price action, you're fully exposed to. You can gain from that. As a portfolio holder, that's what you're in the game for, right? You are exposing your portfolio to market risk so that it keeps on growing, that your portfolio keeps growing with positive returns. And you want to limit the downside of risk on your end. In terms of margin requirements, as I mentioned earlier, future contracts, whether you're a buyer or a seller, you need to set aside margins, and they are mark to market daily. In the case of options, only a short position is mark to market. I mean, in fact, both are mark to market daily, but you are exposed to margin calls only on short options, not on long options. If you're buying options, you pay premium, that's it, no more margin calls. When it comes to costs, for a futures contract, it involves transaction costs and the cost of capital that you need to set aside for margin monies. In the case of options, in addition to transaction cost, the buyer of the option needs to pay premium to option sellers. Selling option requires depositing of margin monies and therefore cost of financing insofar as the margins are concerned. Liquidity, all things being equal, futures are a lot more liquid than options. So as traders, as portfolio managers, you need to kind of evaluate the liquidity profile of the contract before participating in these options market. So with that, I move to section 2. Maybe I don't get to see the questions at the same time as I'm running this. Are there any questions that anyone wants to ask?
Not at the moment. Yep.
Okay, thank you. Thank you so much. Yeah. All right. So we move on to section 2 now, which will be an overview of equity index options. And we were talking of liquidity. The one thing that you need to be least concerned about when you're trading CME equity index options is liquidity. They are very, very liquid. And we will talk about that now. So equity index options, there are many of them. What we want to focus on are, in fact, just 2 of those today. So the options on E-mini S&P 500 futures has been around for a long time. They're very, very mature products, deeply liquid, but they're very large in size. For average retail investors with a relatively smaller portfolio, when I talk relative, I'm talking relative to family offices, hedge funds. This requires a lot of capital commitment, both on options on E-mini S&P 500 futures and options on E-mini Nasdaq 100 futures, are large contracts. We'll come to the contract size in a while, which is why CME introduced almost 10 years ago options on micro E-mini S&P 500 futures. Why did they do this? For 2 broad reasons, right? One, it makes it affordable for a vast range of investors to participate, because you don't want to be putting all your money in one single basket into US S&P 500 index or Nasdaq 100 index. You want to have a diversified portfolio. So which allows for granular investments into these products, which is why the micro contract and the options on these as well, right? So by the same token, there is options on micro E-mini Nasdaq 100 index futures. And in the next slide, we look at the contract specifications in summary. What I want to show you here on this slide is the liquidity profile. Over the last 10 years, these products have become very, very liquid. Just look at this, right? Let me just focus on the S&P 500 ones. So at the right at the top is the main contract, which is the quarterly options. The average daily OI is 1.7 million lots, very liquid. On a daily basis, ADV, for most of you who would be familiar, is the average daily volume. It is about 135,000 lots on a daily basis. That's massive. Then the monthly options on E-mini S&P 500 monthly options, also liquid, 146,000 lots on a daily basis, average this year. And relative to 2023, that's grown by 3%. Then if you see weekly options, you have a daily expiry, right? You have a Monday expiry, Tuesday expiry, Wednesday, Thursday, Friday. Those again have grown massively in 2024. If you see right across, Monday options have grown by 27% relative to 2023 and 29% for Tuesday options. And if you see the volumes, they're substantial. If you see the Friday options, they trade about 500,000 on a daily basis. That's massive. And if you see the OI as well, that's 2.65 million lots, which is the average daily OI. So again, one thing that you can not worry about when you're trading CME index options is liquidity. It's very, very liquid. Why do we stress so much on liquidity? Because liquidity is what allows you to get in and get out of your positions with least amount of loss by way of spreads. Your ability to, the price at which you buy and the price at which you are forced to or chose to sell, the spread is small when markets are liquid. And that's the beauty of these products, in that they're heavily participated and super liquid. So in summary, right, the contract specifications are available on the CME website. So this tries to summarize the contract specification. Again, I have pulled together, there are many, many index options on the CME. So we are focusing mainly on the E-mini S&P 500 micro options, right? So let's quickly just run through the third column, if you can bear with me and focus on the third column. So The underlying is micro E-mini S&P 500 stock price index futures, which is the micro contract. Why do I stress on micro? If you look at the main contract, the size of the main contract is S&P 500 index, which is 5,800 points into $50. So we can imagine, right? It's a fairly big number that we're talking about. So we're talking of $50 into 5,800. We're talking of a contract notional size of 290,000. Big, fairly big. So if you have to participate in this contract, the margin that you need to set aside is substantial. Compare that with the micro E-mini contract, it's 1/10 the size. So from 290,000, you're now reducing the notional size to 29,000. So, and that's a big one. Minghui, thanks for that. There's a question, and I'll answer that before we pass on to the move on to the next section. Thank you so much. And the price for these options are quoted in US dollars and cents per index point. So what you see as a price of the option is the premium essentially. And what are the premiums quoted in US dollars and cents per index point. So the trading hours, this is another beauty of these products, right? They trade Singapore time, Monday 6 a.m. to Saturday 5 a.m. Practically 23 hours a day. Between 5 p.m. to 6 p.m. Eastern is when there's a daily maintenance period. Barring that 1 hour, these products trade 23 hours a day, 5 days a week. So available all the time. Again, the expiries, Monday to Friday, weekly expiries are at 4 p.m. Eastern time to equity special fixing on the respective day of the contract week. And the settlement, these contracts settle into the underlying futures. So if you get assigned on this option, or if you exercise these options, you get delivered into the underlying futures contracts. So those mechanics we will deal with when we cover the same session in part 2. So in terms of the growing franchise, maybe once again, I see 2 questions coming in. Thanks for that. I'll address those questions once we conclude this section to ensure continuity. So just so that we're all aware, right? So these products have been growing very, very strongly, and that's only a vindication of growing demand globally, right? Since inception, more than 16 million contracts have been traded. Year to date, 2024 average daily volume is 32,000 lots daily, right? Up 38% relative to the ADV in 2023. Participation is from 136 countries, so very, very broad participation. 24% of the volumes, essentially 1 in 4 volumes, comes outside the US, 6% from Asia. 19% of the volumes are traded outside US cash market hours. This is important, right? What is cash market? Equity markets. As you all know, equity markets only trades for a few hours in a day, right? 6 hours in a day if I get it right. But the world doesn't stop. Just because US markets have closed doesn't mean the world stops. Events happen. Announcements in China, geopolitical events, something that happens in Japan, weather events, and all of these have implications on equity prices. So the CME products allow you, the participants, to get exposure or to risk manage yourself even when the underlying equity markets are closed. And that's evident, right? 1 in 5 lots are traded outside of US cash market hours. When cash markets are closed, volumes are still getting clocked on the futures market because people have the need and the necessity to risk manage or to trade. So again, all of this is evident in some of the record daily trading volumes that we see on the CME, right? So the micro E-mini S&P 500 options had its best day ever on 29th of Jan this year, trading about 65,200 lots. Micro E-mini Nasdaq 100 options on 31st of May clocked the maximum of 11,096 lots. And these are massive volumes. Here again, I won't berate the point. You get the idea, right? So these products were launched 10 years ago, and year after year, they have grown strongly, perhaps barring the blip in 2019. The volumes on the E-mini options have just been shooting through the roof. So this year so far, it's trading more than 1.4 million lots, right? So moving on to next section, and before I do that, let me take time to answer the 3 questions, or rather 2 questions. So the question that we have received is, in your opinion, what is or are the differences between trading CFDs and options in terms of risk and return considerations? Great question. Again, so in terms of the payoff profile, roughly these two behave the same, right? Just that in a CFD, take note that you are taking the counterparty risk, which is not the case when it comes to trading listed options. When you're trading CME micro options, you're taking the risk of the CME clearinghouse. So that is your risk that you're kind of bearing on your balance sheet. versus if you're trading CFD with an, again, I don't want to name anyone in particular, any CFD provider, you're taking their balance sheet risk. Between the CME clearinghouse and any CFD provider, it's almost on any given day you would choose a CME clearing because they have all the regulatory frameworks, capital buffers, insurance, etc., to ensure the default doesn't occur. Historically, clearinghouses have almost never defaulted. Of course, never say never. There have been exceptions of some of the Asian clearinghouses having failed, but a clearinghouse of CME stature, that it's a massive tail risk for that to fail. Compare that with a CFD provider, the probability of failure is a lot more higher. Think, Lehman Brothers, right? Who thought Lehman Brothers would crash? But we all have lived through the mini bond crisis in 2008 when Lehman Brothers went down the tube. So that is something to keep in mind. Insofar as risks and returns are concerned, it shouldn't be substantially different because many of the CFD providers are super efficient in the way they price. Also keep in mind, right, when you're trading with a CFD provider, you're almost trading with them, you're trading against them, meaning the CFD provider is trading against you. Your gain is their loss, your loss is their gain. So something to keep in mind. Unlike that, with the CME, it's an exchange. They are not trading with you. They're only facilitating trades on their platform. So something to keep in mind. So then I hope I've answered that question. The next question I have is, you said European option can't be traded on daily basis. Then how could you get contracts of daily or weekly option for European style? I didn't say that European option can't be traded on a daily basis. You can. So there are two different things, right? When we talk of European style of expiry, it only means that you can exercise the option. If you take a step back, option gives you the right to either buy or sell, which is a call or a put. You can exercise. You can say, I want to now buy or now want to sell. Exercise the option only at expiry in the case of a European option. But that doesn't stop you from trading a European option. Trade is, you can open an option position, close an option position. That can happen anytime from now until expiry. Just that you can't exercise. And that has implications in how options get priced. But there is nothing in a European option that prohibits you from trading, from opening and closing a position before expiry dates. I hope that helps you address your question. Minghui, I suppose those are the only two questions for now, right?
Yep, those are the two.
Cool, thank you. So we move on now to section 3, benefits of options and its use cases. First and foremost, as I did mention earlier, right, there is something about asymmetry. There's a concept of convexity in finance. One broad rule that we all can keep in mind is no pain, no gain, right? No risk, no return, almost. So with convexity, if we are able to construct a portfolio that is convex in nature, you essentially engineer a portfolio that gives you disproportionate gain to a given unit of pain. So convexity enables asymmetric gains, right? By the same token, if you build something that has inverse convex property, you're exposing your portfolio to asymmetric loss. Limited gain, unlimited losses. So that's dangerous as well. Convexity minimizes pain. Inverse convexity inherently can lead to maximum pain. Convexity maximizes gains for a given unit of pain. And you'll see what I'm trying to get to in this chart, right? So this is a theoretical chart. So there is a function f of x, and across the x-axis are your values of x. So as you can see from left to right, 145, 165, 185, 205, 225, all the way to 305. Then you see f of x being charted across the y-axis, right? Once it crosses around 235, the f of x rises astronomically. It's not rising through an arithmetic proportion, right? When you move from 235 to 235, it's what percentage increment is not the same in f of x. F of x increments are far more larger than x increments. So this essentially is convexity. Again, for those of you who may find the numbers on the x-axis somewhat familiar, could be stock traders. So those are Apple share prices. What you're looking at is a long call option on Apple stock as an underlying. As the price of the underlying stock increases by fixed increments, you get an outsized gain on a long call option on Apple shares. But what if your views are wrong? What if Apple share prices pulls back? What if it prices drops to 205, 185, 165? Don't have to worry, right? Because when it pulls back, your losses are limited. Your losses are limited to $1,000 On the upside, you could potentially go to 3,000, 5,000, 7,000. One of the things that you, as an astute trader, that you'll be looking for is my reward to risk ratio. How much am I exposing myself? We had a client a few years back, an Italian client, and he would always say this, right? Anytime he trades, he always wants to have a 4:1 reward to risk profile, meaning 4 units of reward is what he would like for taking 1 unit of risk. Many retail investors typically end up doing the reverse. For 1 unit of risk, sorry, for 4 units of risk, we only expose ourselves to 1 unit of reward. So that skew, if you're able to consistently build a portfolio, build your trades in such a way that for every unit of risk, you have multiple units of reward over a period of time, like it or not, your portfolio will advance, will grow. You will be profitable over a period of time. So options is one of those instruments that helps you to accomplish this. Again, keep in mind, right? It's about what position you have an option. If you're long option, it gives you convexity. If you're short option, it gives you inverse convexity. What you see as a massive gain could become a substantial loss. So something that one has to keep in mind while trading options. Next, options are tailored for continuous risk management. What do I mean by that? Well, most of you who have traded before, you almost know this rule, right? Always have stop orders. Never put a position without a stop in place, right? Because when you're watching a soccer game, when you're out on a holiday, markets may move, prices may jerk badly, and that can cause huge losses on your portfolio. So you don't want that to happen. So what do? You build a stop order. The stop order is working for you, typically a GTC order, right? Good till cancel. But when markets gap up or gap down, and we've seen, right, only in textbooks do prices move continuously. In real life, markets gap up and gap down. And when they do that, you have a problem. Prices can jerk badly and your stop losses won't get executed. What is the alternative? You can use futures to neutralize price volatility, but you're not in this game to neutralize both upside and downside risk. You want the upside potential while minimizing downside risk. Futures won't do it for you. Options, when used astutely, is a fine portfolio risk management tool, right? So as with many tools, options are typically misused. In fact, a lot of times they're badly misused, which results in them being wrongly labeled as weapons of mass financial destruction. Warren Buffett famously said this. Again, its question is, how do you use the tool? If you use it wrongly, it will lead to bad results. If used smartly, it can lead to meaningful results. I want to illustrate this with a chart of Tesla share prices, right? So as I said, only in textbooks do you see a price curve that moves smoothly. But look at this, right? If you can see my cursor, so there is this big drop in Tesla share prices upon results. Massive drop. Imagine you were holding on to Tesla shares. You had a stop loss around here. Do you think you'll get filled? You wouldn't. When market falls through a gap and when it opens here, you will get a fill here and not here. And this loss you can't protect. It's too late then, right? The market just falls through your stop loss and you get a very, very bad fill. You book a loss. You crystallize a loss. The only way to hedge against this, I wouldn't necessarily say only way, an optimal way to hedge against this is to use options. And options can do that for you, right? It's not only on the downside, even on the upside. If you can see here, a big jump, a massive gap in the marketplace. Here again, you can see gaps, right? So it's these gaps that typical stop loss orders or futures cannot necessarily cater for. That's when options are an astute, fine instrument that can help you manage risk in these gaps in marketplaces. And this can happen for any market, right? So perhaps index options don't suffer as much, gap ups, gap downs, but they're not necessarily resistant from them. They can also be exposed to these kind of risks. Okay, with that, we move on to section 4, risks in trading options. As I said earlier, any endeavor, any business endeavor, any trading endeavor, investment, outreach has risk. No two ways about it. But trading and options create unique sets of risk. And we want to highlight 2 of them today, right? What are these idiosyncratic risks that are specific to trading options? One is a gamma squeeze. I won't get into the technical details today, right? So this is a Greek term, option Greeks. So there's something called as a gamma squeeze. And when this happens, option traders suffer big losses. What is a gamma squeeze? So let's say you hold a position and your expectation is that the markets will stay flat, won't move as much. And then it starts to move because your view wasn't right. When it starts to move, it results in losses, and in some cases massive losses, and that can result in a portfolio getting beaten down badly, right? That's a gamma squeeze. The second idiosyncratic risk in trading option is theta decay. What is theta decay? In this context, you are expecting prices, the underlying prices, to move sharply or to move even, right? And sadly, much against your expectation, it doesn't move at all. When it doesn't move, when a price fails to move in your favor, options become worthless and they expire worthless, and all the premium that you've paid is wasted essentially. So in one case, it moves when you didn't want it to move and you suffer losses. In the other case, you expect it to move, it doesn't move. Then also you suffer a loss. So these are two idiosyncratic risks specific to option trading, gamma squeeze and theta decay. What we will do in part two of this webinar in 2 weeks' time is to kind of flesh out more details around both of these and show you methods and techniques in which you can minimize the effect of both gamma squeeze and theta decay. And again, as with any trading endeavor, right, you can almost never eliminate all risk. All that you can do is minimize them. And that's something that we will look to address in the next part of the webinar. So before I move on to the next section, there is one more question. Thanks, Mingwei, for sending it over. So the question is this: on the explanation of convexity, Apple, are you specifically referring to long call or put position? So let me answer that. It's a long call, by the way. The question continues, or are there other option strategies that give you this type of limited fixed risk example? So yeah, the answer to that is yes. The beauty of options is that you can construct any different combination, right? You can replicate any sorts of payoffs in multiple ways, but each one of them comes with its pros and cons. So the long call is perhaps the most simplest way of participating, and sometimes the beauty and power lies in simplicity. So to replicate strategies that have limited or fixed risk and unlimited upside, there are many ways of achieving this. So we will talk about some of them when we come back again in 2 weeks' time. So I hope I've answered your question. So with that, I'll move on to the next section. In fact, I'll hand over to Pranay, who will cover section 5. Pranay, once you get started, let me know and I'll move the slide.
Yeah, hi Sri, can you hear me?
Yeah, loud and clear. Thank you.
Right. Nice to meet you guys today. I'll be presenting on how option payoff charts can be constructed. So Sri, if you could switch over to the next slide, I'll
Yeah.
provide a bit of context on what options payoff charts are and what we'll be covering today. So essentially what an options payoff chart is representing is the potential profit or loss of an options position, be that a long call, a long put, short call or short put, any of those, at various underlying asset prices. So based on how the underlying asset moves, the payoff chart is showing how your position would gain or lose. So these charts are crucial because they help us identify what will happen at expiry. So with these figures in mind, what we can do is get a good idea of what exactly the position is we're getting into. So we can sort of forecast a few scenarios, right? So what happens when price closes $500 higher, or what happens when price closes $500 lower? So we can simulate all of that using payoff charts. So before I kind of take over the screen, right, I'll just quickly run through some of the brief situations in which you would use each of these strategies. So Sri had already described some of this previously, right? So when you want to use a long call, maybe you have a bullish view. So a long call essentially provides you exposure to the upside of an asset. So if you expect an asset price to rise, you can enter a long call position, and your payoff would be, as we mentioned, convex. So your potential profits, would be far higher than your potential losses. And for each unit move in the underlying, your payoff again would be magnified. So similarly, a long put can be exercised when you hold a bearish view, so when you expect prices to fall. A short call and short put, a little more nuanced. So in this case, you're going short the options. So what you're essentially doing is you're selling the options. So you're locking in that premium, which you would pay if you were on the long side. And you're instead kind of locking that in, and any future movements will result in a deviation from that initial profit. So a few things that we will require in this are the data points that are mentioned on screen. So the type of options, the trade direction, the price, the transaction costs, the strike prices, and the option size. So what I can start now, I can kind of take over from here, Sri. Thank you.
Sure.
I'll just start sharing my screen and. Within this, you'll be able to see some of this info kind of already inputted, right? So what we can do is we can start with talking about a futures position, make it simpler, right? Just to set the stage, in the next 2 weeks, companies will start reporting their earnings once more. In the last earnings season, most of the large firms sort of beat on their earnings, so their results were higher than expectations, and consequently, the prices rose. So coming into where we are right now, in the next 2 weeks, as firms start to report earnings again, and they have the potential to beat, you might hold a view on the upside. So you might expect the S&P 500 to rise over the next 2 weeks. So what you can do is a straightforward long futures position. So what does a long position mean in this context? It just means buying the futures contract. A short futures, conversely, means selling the futures contract. So in this case, the payoffs are somewhat more simplistic than an options position, right? So if I lay out some potential strike levels, so these are underlying prices, right, where the S&P 500 will be 1 month from now. So this future expires in September. So where prices will be at that point. So if I fill in some of these values, say from 4,500 all the way to 6,000, and we simulate what happens with the long futures position. So as I said, this is just a buying, this can be equated to buying a futures contract, right? So when we want to calculate profit for a long futures position, what we'll do is we'll take the final price, so the price at which we sell. In this case, that will be the price later on, and we'll subtract the initial price. So in this case, that would be the current price. Then we'll multiply that with the contract multiplier, which, as Sri had mentioned earlier, for MES, which are micro S&P contracts, that's a contract multiplier of 5. So this will give us a potential payoff if prices fall from 5,500 to 4,500, and we had initially, expected prices to rise, and we entered this long position. If this happened, we would be down $5,000. So another thing when we're doing this in Excel is we will want to sort of select a permanent reference for the current price level, and then we can just extend it down. And as you can see, we'll now also see the payoff in case prices rise. So anytime above 5,500, this position is going to be making money. So each $100 move is in fact going to be returning a profit of $500 in this case. Similarly, we can create it for a short futures position. Just that in this case, we'll be doing the opposite. We'll be selling the futures right now, and then we'll be buying them when this contract expires, if you want to visualize it like that. So in this case, our final price, which would be our selling price, would be the price that it currently is trading at. So that's the selling price. And from that, we'll subtract the buying price. So that, in this case, will be the price at expiry. And once again, we'll do the permanent reference, and we can see that if instead we had entered a short futures position, prices closed at 4,500 in September, we would have made a profit of 5,000. So now you can see, the graphs are kind of opposite. And as Sri had alluded to earlier, this is kind of to be expected, right? It's just going to be a straightforward line between uh, profit for a long futures and a short futures. The other thing, a small nuance I'll highlight, which was also on the slide, but you might see that the chart isn't looking as we would expect, right? So the reason behind that is that oftentimes in Excel, you'll run into problems with it understanding labels, which are formatted as text. So instead, what we can do is we can manually set the label range. And with that, it's showing us the two lines. So for long futures, that's the orange line. And for short futures, that's the gray line. So that's it for futures, right? So straightforward, simplistic. As prices rise, you make a linear payoff. As prices fall, you make a linear payoff. In the case of options, things are slightly different. So heading into the same kind of scenario, right? Earnings are coming up, and there is the potential for for prices to rise. But once again, we want to take advantage of the fact that options have this fixed downside property. So in this case, we want our downside to be limited to the premium paid. So I already have a few values entered here, and I'll just briefly walk through them. So first, we have the current price. So this is the underlying price in this case. This is the underlying futures price. The next thing I have described here are the options codes and the options expiry. So this option has a contract code of EXN24. What does that mean? EX is the contract code for micro E-mini options. N is the month of the contract. In this case, that's July. And 24 is 2024. So as you can see, this is expiring in July. Strike level, this is the level at which, above which a call option can be exercised for a profit. Now, in terms of premium, as Sri mentioned, there will be the premium that's quoted in index format, but each contract actually provides you exposure to the contract size, right? So while the premium may be quoted as 20, what you'll pay is for the entire contract, which is 5x the index value. So in this case, the overall premium we would pay would be $100. And then the contract size, that's the same as futures as we walked through earlier. So the other difference I'll get into is how do we calculate a payoff, which is conditional in some ways, right? An option position would not pay out if this contract expired with the final price, the settlement price, below the strike price. So in that case, the option would expire worthless. If it expired above the strike price, then you could execute that and walk away with the potential profit. So the formula in this case would also be conditional. I have that listed out in text over here, but we'll kind of add those values in to see what that looks like. First, what I'll do is I'll just add a row of a column of the potential price levels. Once again, we'll maybe take it to 6,000. And we'll want to calculate long call PNL. So in this case, as I said, it's a conditional payoff. So if the expiry price is higher than the strike price, so the strike price is there, and we can make that permanent. In that case, our payoff would be the PNL minus the premium paid. So the PNL, that would be calculated in the same way, where it's our final price, so our selling price, minus our buying price. That would be A9 minus our buying price, which would be the strike. And we'll make that permanent as well. Add the contract multiplier. And from that, we'll subtract the premium that we paid. So in this case, that's here, P5. And similarly, we can make that permanent. And if this position expires below the strike level, right? In that case, our downside would be the premium that we pay. So it would just be P5 in this case. And if I enter that at the price of 4,500 at expiry, the long call position would lead to a loss of $100. But as I extend this lower, and especially as I reach the strike level, you'll see at the strike level, I'm still, not making any money. But if we start to increase above the strike level, all of a sudden, our payoff is going to start rising really fast, right? So for each $100 move, our payoff is instead far larger. So if we were to plot this in a similar way, another nifty trick that you can do to avoid the error that we saw previously is to just convert the potential price column to a text column that allows it to show cleanly on Excel and it does not cause problems. So we put this up. As you can see, this is the payoff chart. As prices rise above 5,800, our position starts to make money, but our break-even point in this case would not be 5,800. It would be above 5,800 because at 5,800, we're still not making any money and we've still paid some premium. So our break-even point in this case is somewhere between 5,800 and 5,900. So if prices rise above this level, we'll be making money and our payoff will be substantially larger than our potential loss. So our potential loss is always going to be capped to $100. Our potential profit, if the index itself were to hypothetically rise to 6,600, would be 3,900. So that's that sort of outsized payoff that Sri was kind of describing earlier, right? Uh, Another position that I'll walk you through simulating is a short put. So similarly, I'll just add in the other values. And in terms of the formula itself, as I mentioned, it's going to be similar. I have that listed down there as well. Just that in this case, the option would be exercised if the final price is below the strike price. So if our I'll have to correct myself. So as this is a short position on the option, essentially what we're doing is locking our potential profit at the premium that the buyer of that option is paying for. So in the previous example, what we were doing is we were buying an option from a seller and we were paying them $100. So if we sell an option, essentially what we're doing is we're locking in our price, our potential profit of $200. Any other movements below this, strike level would lead to losses on this portfolio, and that's the asymmetric loss that Sri was talking about. So if I was to simulate this, right, what would this kind of look like? So if this option expires, if the final settlement price is below the option strike price, so if it is above the option strike price, in that case, our options position would be paying out a fixed sum equal to the premium that the buyer paid. So in this case, that's just B5. But if prices fall below the strike level, the buyer of the option can then opt to execute that option, and that leads to potential losses from our end because as we've sold them the option, we kind of have to, you know, uh, be part of the settlement procedure where if price falls below the strike level, we would be liable to kind of pay them the potential losses from our end. So any massive profit that we were seeing here, that's all being paid for by the option seller essentially. So in this case, that would just be the payoff, the fixed payoff in this case, which is the premium. And from that, we would subtract the potential P&L. So in that case, that would be this. That would be the final settlement price minus the strike price. And can make these, sorry about that. Right, that's an F. Yeah. So our potential payoff is always going to be capped to B5. Uh, if otherwise, our loss would be our loss would be defined by the amount that the index has moved down by. So our strike level was at 5,500. The prices fell below that. So essentially, we would be covering those, and that would lead to a loss from the option seller's end. So if I extend all of this down with permanent references, you'll be able to see the payoff for a short options position. So in this case, as Sri described, the asymmetry is kind of going to be hurting us bad, right? So our potential profit is always going to be capped at $200 in this case, but the potential losses, they're practically infinite. So as the index keeps falling, our losses would continue to mount. So this is one of the reasons that short options positions can be highly risky. Yeah. So if I just show you all the three options payoff charts, and you can let me know if you kind of have any questions. Hey, man, are there any questions in the chat?
No, Pranay, thanks for asking. So no questions as of now. So there's one question that I'm clarifying in terms of the risk to reward ratio.
Mm-hmm.
So Irina, if I could clarify it verbally, if it's easier. So the trader that I was referring to, an Italian trader, so to him, it's the potential loss at stop loss level and the maximum gain at take profit level. So that ratio of reward to risk, to him, he would always get into a trade. In fact, he would insist on getting into a trade only when he has 4 units of reward for every unit of risk. So 1:4. Let's say your stop loss gives you a maximum loss of $100. If the upside was not $400, which gives him 400 by 100, 4:1, he wouldn't get into the trade. So which means whatever that he's trading, whether it is shorting something or buying, going long on something, the expectation would be that the price has to have the potential to move so much so that he gets $400 in gains and maximum loss of $100. So that's what he had in mind as a rule of thumb. There's one more question, Pranay. So this question is, at what situation we need to short since the upside profit is limited? So again, great question, right? When it comes to shorting anything, whether it's shorting shares or futures or options, one has to be very careful because the world is very different when you short something. You could get squeezed very easily. So unless someone has deep experience in trading, shorting is a risky adventure. So back to your question, at what point we need to short since the upside profit is limited, right? So you would be shorting when typical rules of thumb again is if you expect a price of something to keep on rising, if you believe that the downside of the risk of the asset falling in value is small, then you could short a put because you know that this is going to rise. Think of Nvidia, right? Every quarterly results, the share price keeps going up. If you have enough insights to say that next quarter results as well will be solid, share prices will go even higher, yeah, then you could go short, Nvidia shares, rather, short put options on Nvidia shares at, let's say, $120 a share, because you know that the probability of it falling from 130 to 120 and below is very small. It'll either stay at 130 or above, in which case this $200 that Pranay illustrated in the third tab is almost a profit that is certain to be captured by you. Come to think of it, 90%, research shows that 90% of options expire worthless, which means option sellers make money 90% of the time. It's that 10% that they're exposed to a loss. But sadly, it is that 10% that can actually knock off portfolios completely, can get decimated, right? So the fastest way of losing money in trading, one of the fastest ways is by trading options, is by shorting options. You can short options, nothing wrong with it, but you need to understand how do you manage the risk of shorting options. I hope I've answered your question. Cool. If there are no further questions, we have assembled a short poll of 10 questions just to quickly recap what we have presented over the last 1 hour. Maybe if you could kindly bring up the poll questions, please. Okay, the first question, which investment allows for unlimited upside potential and limited downside risk? We'll give up to 45 seconds before we conclude here. Okay. Perhaps we can end the poll here. Mikvi, thank you. Yes, so majority of you have got it right. So the instrument that allows for unlimited upside potential, limited downside risk is options, not futures, right? Futures or future spreads are exposed to both upside and downside risks. And in theory, in an unlimited way, spreads can tear badly. I've seen clients who have lost significant money by trading spreads. So it's only in options that you can cap your downside while giving yourself unlimited upside potential. Before we move to the next question, there's one more question that's just come in. So the question is this: for the first time to learn option, this is a bit too fast. I accept and pardon us for that. In 1 hour, it's quite a bit to pack. So your question is, what's the proper way or course for beginners to be able to equip the necessary skills to execute actual trades? So what we could do as we send out the materials, we will also suggest potential trading materials that you can make reference to be able to understand, how to trade options in a meaningful way. So thanks for the question. We will send in that references when we send out the slides. Mingvi, if you could bring the next poll question, please. Okay, the question is, do buyers of futures need to deposit initial margins? We'll give you 30 seconds. I know we've run past the time. Okay, we could end the poll now, and the majority are right. Whether you buy futures or you sell futures, you have to deposit initial margins. If you remember, both sides, both parties to a futures contract have obligations to keep up the promise. So they need to deposit margins. Only in options. If you buy an option, you don't need to set aside margin monies. You just pay premium, no margins. Thank you for the responses. Minghui, question number 3, please. Do majority of options expire worthless? Yes or no? Should be simple. We'll give the participants up to 30 seconds. Okay, we could end the poll. So yeah, majority of options, research shows that majority of them expire worthless. It's no different from insurance contracts, right? Most of you would have bought a travel insurance, medical insurance, whatnot, fire insurance. Most of the time, year after year, you're paying premiums. You rarely claim, and you're happy that you're not making a claim. But it is the way the market is. So majority of them do expire worthless. Thank you for responding to that. The next question, please, Minghui. Thank you. All else being equal, which of these trades have the highest risk profile? So when I presented earlier, I showed you the payoff from buying calls, selling puts, and selling calls. Which is the most riskiest of the three? We'll give you a bit more time on this one. 45 seconds. Okay, 10 seconds to respond. 2 seconds. Yeah, can end the poll, Minghui. Yep, surprise, surprise. So the riskiest trade, one with the highest risk profile, is C, selling calls. As I said earlier, when it comes to at least equity options, equity index options, it's unthinkable that share prices will go negative, unlike oil prices, right? WTI prices drop to minus 38. But stock prices, the lowest is zero. It won't go below zero. As a result, selling puts, the risk is somewhat limited compared to selling calls. In calls, how high can a share prices go? As high as one can imagine. You never know. The mania of markets can never be underestimated, right? So GameStop, it's a company that has dodgy fundamentals, but meme stock traders pushed it really, really high. No justification, no fundamentals would explain why a share price should go from 30 to about $450 in a short space of time, but it did. Anyone who had sold calls then would be losing their shirt and more. So selling calls is the most dangerous. In general, a rule of thumb, buying options, safer, limited downside, unlimited upside. Selling in general is dangerous, but between selling calls and selling calls are more dangerous. Hope that's clear. So thanks for answering this. Fifth question, Minghui, thank you. So the CME micro E-mini futures are a fraction of the E-mini futures. Question is, what fraction is it? Is it a half, 1/10, 1/100th? Okay, we'll give you up to 40 seconds on this one, perhaps. 2 seconds. Okay, we can close the poll. So the right answer is 1/10. The majority of you have got it right. So it's not half, it's not 100, it's 1/10 of the main contract. And that's what makes it affordable. As I mentioned earlier, the main S&P futures contract, the E-mini S&P 500 index futures, the notional value is $290,000 US dollars, fairly big. But the micro contract is 1/10 of it, $29,000. That's a lot more affordable, and also for large institutions as well. It helps for granular hedging, and that's why these products were launched and they're so popular with investors as well. Thanks for answering. Minghui, the next question, please. Okay, what proportion of equity index futures trade during non-US hours? 7.2%, 19%, 27%. To 30 seconds on this one. 10 more seconds to go. Okay, someone got it at 19%. Okay, 19% seems to be the dominant answer. We can close the poll. Yep, 19% it is. So 19%, 1 in 5 lots roughly, trades outside of non-US equity trading hours. Why? Because the world is moving even when US equity markets are closed. So that creates both opportunity and exposes portfolios to risk. And these products help you to manage risk even when US equity markets are not open. Thanks for answering. We move on to the last but 3 question. Question number 7. Minghui, please. Thank you. Which of these are not, take into account, which of these are not benefits of trading options? Asymmetric gains, guaranteed profits, continuous risk management. Which of these are not benefit of trading options? 30 seconds on this one. 12 more seconds to go. Okay, this was a tongue-in-cheek question, right? We can end the poll. Guaranteed profits. So if at any point in time, we've gone through this so many times. I've been in capital markets for more than 20 years now. Any point in time, anyone says guaranteed profits, that should be the first ever red flag, right? There is almost no such thing as guaranteed profits. All investments are exposed to risk. Options don't guarantee profits as well. There are a whole range of YouTube financial influencers, promoting all sorts of funky things. But one thing's for sure, there is no guaranteed profits. Anyone ever says guaranteed profits, that should be ringing alarm bells for you instantly, right? Thanks for answering. Last but one question, Minghui. Question number 8, if you could bring it up, please. Thank you. What are the 2 idiosyncratic risks of trading options as discussed earlier? Puts and calls, American and European, or gamma squeeze and theta decay? 25 seconds on this. I know I don't want to be holding you guys. It's already 8:15. 7 seconds to go. Cool. Yeah, we can end the poll. You're right, spot on. Gamma squeeze, theta decay, very unique, idiosyncratic to our trading and options. Last and final question. Minghui, please. Are there risk mitigated methods of trading options? Yes or no? 10 more seconds. Okay, perhaps you're too tired, too many questions maybe. Yes, that's the right answer. Maybe we can end the poll. Yeah, thank you so much. Thanks, Minghui, for coordinating this. Those were the questions, and you're spot on. This kind of is a nice segue into part 2, where we will be covering some of the risk mitigated ways of trading in options. Again, in the next version of this webinar in 2 weeks' time, we will highlight ways in which options can be used very sensibly, even to generate yield from products that generally do not, provide a yield. And those are possible only through options. And those are some of the risk mitigated ways of using options. And that's what we will cover in the next session. So I'm just trying to see if there are any further questions. Maybe anything that you have come across. I don't see anything else. What we will do is when we send the materials out, we'll make references to study materials that are useful for participants to read up before they can start participating meaningfully in these marketplaces.
Right. I don't think there are any more questions from the crowd. And with this, we can. Oh, sorry. Let me just share my screen. Um, yeah. Okay. I am going to take this time to share a very timely promotion we have right now for options. All Phillip Nova clients can trade the CME Micro E-mini S&P 500 and Nasdaq 100 options at only 50 cents in the month of July. So don't miss this chance to apply what you've learned from the session tonight at a discounted rate and open a multi-asset account with Phillip Nova today. You can scan the QR code for the full promo details. And with that, we have come to the end of tonight's webinar. So thank you again, Sri and Pranay, for the very insightful and engaging session. And thank you everyone for your time tuning in. We'll be sending everyone a link to today's webinar recording so you can watch it again if you'd like to. And we'll see you again on the 23rd for part two of the series. And if you are here watching this live, you are already registered for part two, so you don't have to register again. Yep, that's all for today. Thank you, everyone, and good night.
Thanks, Ming Wei. Thanks, everyone. Good night.
Thank you.